Hey everyone, today I wanted to make a quick video on ICT mitigation blocks, how to identify them and trade them. So if you didn't watch my last video on breaker blocks, I'll link that in the top right because this is essentially the same exact concept with one key difference. So if we were looking at this as a breaker block setup instead, we would want to see this short-term high, create a short-term low, then run that high, and then create a market structure shift. But in a mitigation block scenario, we do not need to run this first high. The psychology of the setup is exactly the same. It punishes traders who got long in this area before the bearish market structure shift. Those traders got trapped and will look to mitigate those losses as price retraces back to this old short-term low where we expect to see some resistance here. So again, in a bearish scenario, we want to look in between these two lower highs. We want to find the short-term low in between them and then use the last down close candle right here as our mitigation block. And in a bullish scenario, we want to look in between these two higher lows. We want to look for that short-term high in between the two and then find the last up close candle that will act as our mitigation block. So we're going to look at some examples and I'll try to provide some more context as we go along as we get into some more complicated examples. Right here we have a short-term high created, a swing low, and then a lower high. Then we have plenty of displacement here marking a bearish structure shift. So we're looking in between these two lower highs. We're looking for that short-term low. And then the last down close candle in between that is our mitigation block. So since this last one right here didn't have a significant body to it, I want to be looking at this one with some more range in between the open and close. And so this candle right here is going to be our mitigation block. And additionally, if you were looking at this entire leg lower, you could see some more confluence to add to your setup. And it's that if we're looking at this swing high to this swing low that we created, we would be at an optimal trade entry between the 0.62 and 0.79 retracement levels. So you could look to get short in this mitigation block, throw your stop at these old highs or these right here, and obviously targeting sell side liquidity. So another example here framed on a pretty low time frame. We're in the middle of this uptrend and we see that these lows are ran really quick. We see that a short-term low was created. We trade higher to create a short-term high, then back lower, but do not exceed this previous low. So we're setting up for a potential mitigation play if we do in fact have a market structure shift above these old highs. So we do displace above those old highs. So at this point we can say, okay, I want to look at these two previous lows, find the short-term high in between them, and then find the last up close candle in that series. So again, this last up close candle doesn't really have much range in the body. I think this one is a much better spot to place your mitigation block. But if you extend that out in time, you can see after the market structure shift, we retraced and respected that area and proceeded higher. Now for a little more context here, we can see that we are approaching low of the day in this scenario. We have this pretty steep down move, take out some liquidity on the way down, but do not break the session lows. So we break some lows along the way, put in a short-term low, trade above to create a short-term high, and then back down, but do not break the original lows that were created. So again, we could be setting up for a mitigation play if we do in fact shift structure to the upside above this short-term high. I don't have it marked out here just because there's not much room in between these candles, but that is obviously exactly what we do. We take out these highs with significant displacement and leave behind some fair value gaps. So we can look at these two lows, find the short-term high in between. The last up close candle is our mitigation block. It has some pretty decent range in the body. We extend that out in time, and that's exactly what we hit before proceeding higher. So again, if you have confidence in that market structure shift, then you could throw your stop at those local lows or these ones right here and ultimately target buy side liquidity up here. Now, if we look at this setup that's framed on a slightly larger time frame, we can see we have this uptrend and then a clear market structure shift down. We create these lows and trade away from it immediately and then do the same with some highs. So now after putting in these highs, we do run them in the overnight session, then quickly trade below it and up higher to create a lower high. Then we do run those lows pretty aggressively, indicating a market structure shift. So we can look in between those two highs, find our short-term low, find the last down close candle in that sequence, and draw out our mitigation block. So price does exceed the mitigation block just a little bit, but it does not break these old highs right here, which we do not expect it to. And if you like to wait for confirmation like me, you could see all this chop right here and just wait for a simple candle close below the mitigation zone after it has been tagged. But either way, however you want to enter, you could throw your stops at these highs or these old highs right here. And zooming out, we can see that these would be some obvious lows to target, which we do eventually hit. And these lows, if you're able to hold on for that long, eventually do get hit as well. So again, some key takeaways. The first is that you do not want to see these initial highs ran for this to be considered a valid mitigation setup. Second is that you want to see significant displacement to mark that market structure shift. Again, displacement is a central theme in all ICT concepts. The more energetic move you have, the more confident you can be that a structure shift would play out in your favor when you do get an optimal entry. And third is that, again, this really shouldn't be overcomplicated. It's nothing more than a simple support turn resistance setup and vice versa. So we create a short-term low, run that pretty aggressively, and it now becomes resistance and we head lower. I know for me, when I was new to ICT concepts, that just helped me grasp the idea a little bit better, being that it's a setup I was already familiar with from, typical retail terminology or whatever you want to call it. Don't make it more complicated than it is. Just like anything else, you really want to see that displacement come in from that market structure shift, and then you can look for your entry, whether that's a mitigation, a breaker block, 2022 mentorship model, etc. If you have any questions, please feel free to leave a comment or message me on Twitter or something. If this video helped you at all, please consider liking and subscribing. That's all I got for today, and I'll see you in the next one.